I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Vantage Go, enabling enterprise-scale underwriting through a single pane of glass. It's great to have a guest of the calibre of Greg Hendrick, CEO of Vantage, back on the show. Not least because his relatively new and young business is still growing fast and there's a lot to catch up on. Now 5 years old, Vantage is set to write around $1.6 billion in gross insurance and specialty reinsurance premiums and is managing $1.5 billion in ILS funds. But listening back, it's the quality and breadth of the discussion we have that I'm really pleased with. Greg is hugely experienced, and once he updates me on where Vantage is and how he sees the market and the firm's strategy within it, the conversation quickly moves on and probably goes deeper into the art of underwriting and portfolio construction than I have with anyone on the podcast so far. We also dissect the best applications of AI and other major trends, such as the flow of business into excess and surplus lines and the boom in MGA and fronting and hybrid carrier formation. Finally, as this is a business set up with a likely 5 to 7 or 8 year initial investor timeframe, and the 5-year threshold has now been crossed, we round off on where Vantage is in its development journey and the prospects for M&A to complete its platform, as well as the chances of a possible future IPO for the business in the medium term. Greg doesn't hold back on any of this. He's a great communicator and knows exactly what he's doing. He speaks with the absolute confidence of someone completely on top of his brief. And I think you'll be able to sense the big smile on his face coming through the audio recording. It's rare to get an opportunity to put everything you've learnt in a successful career into practice, and Greg's clearly been enjoying his time building Vantage. I really enjoyed talking to him and got a lot out of this conversation. Listen on, and I think you will too. Greg, welcome back to the Voice of Insurance.
Mark, so great to be here again. Lovely to see you. I hope you're keeping well.
I certainly am. Yeah, autumn, as we call it over here in Britain, is really kicking in now. We've just changed our clocks, and it's that one of those weird times of the year when I don't know why we can't all agree to change the clocks on the same day. I mean, it's bad enough having time differences, and then it's one of the things I don't know why Europe and America can't just get together and say, let's just do it all on the same day so at least it stays the same time difference. I think I'm a bit closer to you in time because we've moved forwards, but we have to wait 2 weeks before the American continent decides to do the same thing. But there you are. And then we have a corresponding period in the springtime. Anyway, we won't complain. Am I being middle-aged and grumpy? Perhaps. I hope that won't affect our podcast today.
Oh, no, not at all. I always look forward to this conversation. It's great. I love a good jumper. I love jumper weather. I think this whole clock thing is the only way to keep Microsoft Outlook in business.
I don't know. I had to pick loads of leaves off my car, and that was annoying because they were kind of getting down in where the windscreen wipers are, and was parked under a tree, and it was no good. Anyway, back to the point. Another year has passed, and Vantage is maturing at speed. Can you give us a bit of an update? We'll start with an update on where Vantage has got to.
Sure, happy to, Mark. Yeah, hard to believe we just went past our 5-year anniversary of funding. We got funded in October 2020, and 5 years in a blink of an eye. It's crazy how fast that went. We're happy to report that 2025 is going to end up with over $1.6 billion of gross written premium, $1.1 billion of that in insurance, and a little over $500 million in reinsurance. So 2 of the 3 legs of the stool here at Vantage are really coming up nicely and getting on plane. The reinsurance is truly a specialty reinsurance business. We really don't write property cat excessive loss treaty. And we have a single, not figuratively, literally a single casualty reinsurance treaty, mainly because we are 75% long tail in the insurance business and 25% short tail. So those 2 franchises are going strong. And then the third leg is Advantage, which is our ILS vehicle.
Yep.
Chris McEwen and I started that up at the beginning. I felt very strongly because of the relationships we had more opportunity brought our way than our balance sheet could handle. And so in 21, we had a small, less than $100 million vehicle going. But then after Ian in 22, that went up to $1 billion. And now we deployed $1.5 billion in 2025. So
wow. So it's almost the same size as the balance sheet, slightly different.
Yeah, and this is maybe perhaps a bit insurance geeky, but it's not a sidecar, so we don't flow business through Vantage balance sheet.
So it's a pure manager.
Yeah, that's basically that plus the premium is the limit sold. So whereas obviously we operate a leverage model. I think the last thing I'd finish with in the update is we remain AM Best A- rated, but we also did get an S&P rating of A- this year as well, which we're very grateful for. And inside of the usual 5-year waiting period they have to issue a rating. So we're quite pleased by the affirmation of our balance sheet strength.
It's a bit like a mathematical proof, isn't it? That it's quite nice that you can find another way of reaching the same answer. So it's good to be validated, isn't it? 2 is better than 1.
2 is better than 1.
Excellent. Well, it's good that they both agree. So yes, you seem very, very balanced then as a business. It sounds like, because you're getting a nice balance between, obviously you've got reinsurance, which obviously by its very nature is slightly more volatile, but you don't have the most volatile part of that reinsurance. And you've got insurance, and then also you've got some fee earning business as well, which is also doing really well. Where are you seeing the best opportunities at the moment for keeping that growth going profitably?
It's important that it's not I know a number of people have talked about it, and I concur. It's not a single market. There's a bunch of markets going on here. And certainly on the insurance side, yes, the D&O and cyber and some of the other professional lines have been more of a headwind where rates have been declining. There's a raging debate about, is there still adequate margin in there or not? Cyber frequency is up, but severity is down a bit. And so we're in the camp of it looks interesting from time to time, but you got to be really cautious in that marketplace. So there we're behind plan and kind of a slower growth pattern. Property is kind of in the middle. It's coming off, no doubt about it, but it's coming off very, very high levels. And we think still a very, very adequate margin embedded in there. So we're not aggressively growing, but we're still growing in that area. And then where we see both the growth for us, and I think the best levels of profitability for the industry is in the longer tail lines, in excess casualty, in healthcare, in construction, and political risk, and a few of those areas where we think prices are at levels that are yielding good margins, and rates continue to stay at or ahead of our estimated loss trend. So that's kind of a walk on the insurance market. On the reinsurance side, as you noted, there's no such thing as a non-volatile reinsurance book, but we definitely have a lower volatility for sure, focused on true specialty lines of marine, aviation, energy, terrorism, mortgage, crop. I won't name every single one of them, but it's a nice, good, well-spread portfolio. And the same thing there. Some of the markets are hardening, some of them are kind of flattening, a couple of them are softening, but overall, we feel pretty strong. There's some good opportunities in that reinsurance book to continue to grow. And we don't run the place with a mathematical formula that says thou shalt be X% insurance and Y% reinsurance. We do try to grow the insurance business faster if it's possible and profitable to do that. But the reinsurance business has grown every year we've been in operation. And so right now, the split is about 70-30 insurance, reinsurance in terms of gross written premium. That can change as the opportunities change. We're not fixated on getting to an absolute outcome.
I presume also with insurance, is it more of an imperative to grow because you've got a cost base and it is more efficient to be slightly bigger because you need to service insurance more than you do reinsurance?
Yes, it's much more of a people-intensive business. We're now up to 365 colleagues across the whole platform, but easily 75-80% of them are focused on doing or supporting things insurance-related. And so there's no doubt about it, we certainly envisioned that 1.1 billion being more like 1.5 at this point in our journey. That's just disciplined underwriting, particularly on what I talked about. The D&O and cyber books are not quite where we would have envisioned them being had they been rated well and had capacity not come pouring back in. So we're still working our way through what other things can we do to grow into our frame, if you will, our operational frame that we have to be able to support the chassis of the car.
And how's demand stacking up? I mean, property demand is still there and still there in abundance.
Yeah, I think we can go talk AI, multivariate modeling. We can talk a whole bunch of broker consolidation, broker expansion, a lot of things going on that drive pricing and opportunity, but it's still supply and demand. And in those classes, cyber supply came back, so there's abundant supply and demand has been flat. People aren't buying more D&O limits. They're generally not buying more cyber limits by and large. Property, I'd say it's pretty well balanced. I mean, you could say it's tipping over to supply exceeding demand. Probably true in certain areas. Oddly enough, cat exposed business or peak cat exposed business. And then on the casualty side, I think demand is still ahead of supply. There's some new capacity coming in, but not a lot. And certainly not a lot of traditional capacity coming in on the insurance side. So it's always about supply and demand. And we see that play out in each of these markets.
Where are you happiest? I mean, you're happiest in the casualty classes where you can see that rate. And because of the nature of that market, you're getting shown a really good showing of business because there is an opportunity to write that business that perhaps, if you were here 10 years ago, you wouldn't have been given that opportunity.
Absolutely. It is a labor of love to build anything from scratch. As you know, it's a labor of love to build an insurance carrier from scratch. And certainly we needed that market opportunity. Yeah, our excess casualty submissions grow 30% every year. It really is a matter of how do we give our underwriters the tools they need to be able to service the flow of submissions coming in. And we haven't seen that slow down at all in the 5 years of our existence.
What about demand specifically into E&S, for example? I mean, now that the market's confidence has returned to almost all spheres of the market, often that used to be accompanied by slightly greater retention in that admitted lines market and less spinning out into the excess and surplus lines market, or sometimes that flow actually reversing. What's it like at the moment? Obviously, we're only able to speak in the absolute aggregate that we're at this past the peak hard market softening type phase. Are you noticing any of that flow reversing? Some of the things that you saw 2 or 3 years ago not being submitted this year?
There's kind of two parts to that E&S market. There's what I would call the cyclical piece.
Yeah.
An example that comes to mind, Midwest commercial property insurance. For a while, there was a flow after a couple of heavy, severe convective storm, tornado, hail losses seasons. There was a move from admitted to E&S. I would say this year, you might see that is coming back, and 26 might have more of that. And I don't know, the cyclical part may be bigger than the part I'm about to describe, which is it's just two businesses trying to execute a contract, and they are sophisticated buyer, sophisticated seller, and the need for a heavy regulatory environment is not as much required. And where we participate and where I can speak the most to is in that kind of middle, large, upper middle market to large corporate client. And there, I think it's more of a permanent change of, hey, we're going to sell XYZ Corp D&O insurance. We don't need to have it as an admitted form. They want customized coverage. We want to do that. We want to have some exclusions that we think we need in this particular insured. And so we do that on a non-admitted basis. I think that market was not growing as fast as the cyclical market, but it has been growing and will continue to grow at a steady pace as you try to solve the unique risk needs of this modern world for sophisticated corporate clients.
Yes, the world doesn't seem to be getting any less complicated, and therefore
No,
the insurance probably isn't going to either.
exactly.
What about the other flow in the 5 years that you've been in existence? We've seen a continuation of that trend to distributing insurance through MGAs, and it seems to have run parallel to that. E&S, obviously, it suits specialist niche underwriting. Do you think that also might be hitting its peak? You can have a contrary view to say, actually, MGAs, there's more tailwind for MGAs. The softer the market gets, the more carriers are likely to support them.
Well, I just got done saying supply and demand is everything. There is far too much supply of MGAs and front companies. That's not to take a shot at any particular one or another. That's not what I do. I don't believe in that.
No, I would have to agree, because it's really hard for me to keep up, and that's my job.
Yeah, you read the headlines and the names that are new to me, and I do this day in and day out. So there's too much supply. I fundamentally believe there's just not enough good business to feed all those MGAs for the long haul. Now, what happens? I don't know. Do the front companies consolidate? Do MGA? I mean, certainly there are firms out there now, well known, that are in the process of rolling up MGAs and bringing them into bigger and bigger organizations. I don't think MGAs go away. They've ebbed and flowed. They survive. And I think there are a lot of very good ones out there that deserve support and backing from carriers. I would observe that the most successful relationships we have about 9. So we don't have MGAs as a business. We only write them mostly to keep all the risk for ourselves. I mean, we do buy reinsurance, but not in the sense of being a front company to seed out 90 or 95 or 100% of it. 3 things need to happen. 1, you need to be accessing some kind of unique distribution or analytical capability. Just trying to go out and do more bog standard through an MGA isn't going to help you. There's got to be some angle. So we have one where the firm has a fantastic distribution in Florida. They write over $1 billion of homeowners business. That's not what we support, but we support them on the commercial E&S side as an example of unique distribution. Or they're going to have some kind of analytical line. The second thing is you've got to be really transparent with the other. You got to be a modern carrier and you got to be a modern MGA, and a lot of data has got to be flowing back and forth. And I will tell you, even the best of it's not without hiccups and bumps and things go wrong when you think you have it right. And the third and probably most important thing after the people that are underwriting on your behalf is that there needs to be some kind of mechanism that when profit is made, some of that is conveyed to the MGA. And if no profit is made, they're not going hungry, they're not starving, but they're not making a lot of money either. And that's a very hard thing to do. There are a lot of situations in this day and age where the MGAs are going to make money, whether the underwriting is successful or not. I don't think that's a healthy recipe. So we do it. We have 9 programs, a little bit of a concentration in property because we felt that was how we could get after the property insurance business the fastest. 4 relationships there and 4 important ones. And they're kind of constructed geographically and product wise so that you have a nice, well diversified portfolio. So I think there's a place for it. I think you can do it. I just don't think there's enough good business in this industry to support the scale of it as it exists today.
It doesn't sound like it's your core thing. You'd rather be writing it yourself, ultimately.
It's about 20% of our top line, give or take. You want to own all the underwriting if you can, but I concede that those days are certainly in the medium term over. Not everybody, even a new 365 person, young hybrid company isn't going to get every underwriter to come work for them. So you do it where you need to.
Well, absolutely. I think there's just some people just want to be their own boss, and that's just the way they'll always be. I suppose one of the theories behind that boom in MGAs has been actually the technology has enabled these companies and the best ones to really disaggregate the insurance value chain and say, I'm going to isolate the underwriting part of that value chain. Back in 30 years ago, when I was placing business with MGAs, they had to be very, very specialist because otherwise we couldn't justify them, particularly sitting in London. It seemed like every time it went through another hand, it added another 10% commission and probably another 3 months delay to actually getting your premium paid, and then working out what the hell's actually going on half the time. Even just getting the account settled was quite complicated and painful. And these days, in theory, not always in practice, but in practice for the best, the technology has really enabled them to be a virtual insurance company and for you to look right through almost in real time at what they're doing. Certainly find out what they did yesterday anyway, and then to be able to really drill down into what exactly they did do on your behalf yesterday and be able to query them and say, and then, be very clear on what that's doing to your aggregation and all the other things. Do you think that's the right kind of thesis to say that technology in the industry is really enabling those MGAs to do that job and to take that underwriting part and be rewarded just for that part of the value chain?
The better flow of data through the better use of technology has definitely enabled the growth of MGAs. It's also enabled the growth of kind of the broker facilities as well. Gone are the days where you're getting quarterly information, 90 days.
Absolutely.
Those days are gone. I mean, you can get some relationships that are real time. Most of what we do does not change day to day to day. It changes on the 1st or the 15th or the 30th of the month when insurance for big businesses renew.
I suppose, and also you don't just delegate something to someone and then be sitting over their shoulder all day. Otherwise, why are you paying them? Because you have to pay someone else to do that. They can't be very efficient.
Yeah. No. You cannot redo their job. That is very We feel strongly that there's a wide underwriting authority given, but that there is a box around it and that we want to have whatever it is, 3, 4, 5 special acceptances a week where you're pushing the boundary of that so that we can communicate with each other about what's the opportunities you're seeing that are on the outside of your core. But you want to let them go do their core business and then use the technology to feed the information through. That's what all of them have monthly feeds. We could do weekly. Again, I don't know that for the business, if I was running maybe auto or home or something small commercial, you probably want to have a faster turnaround cycle on the information, but monthly is great for us, works well. Everything runs through if it's property exposed, through our catastrophe systems. Everything runs through the bordereaux into our premium system. So we feel pretty good about how we have that wired. I think broadly, macroly, the technology has enabled people to do more, I would call it more flow business than ever before. And really, you've seen the big alphabet broker facilities have grown dramatically over the last 5 years.
Yeah.
That's only because there's good data flowing back and forth and there's been a hard market. Those are the ones where when the soft market comes, what business is actually flowing into that becomes the underwriter's job to kind of really figure out, do I still have a good opportunity here? When the market's hard and you can get access to a slug of it, and you want to do that.
Yeah, there was a moment where we really knew the soft market was starting to bite, and somebody who has to remain nameless sort of tapped me on the shoulder and said, well, I have come off that very large broker facility.
Yeah.
And it was like, all right, now we know why, because
Yeah.
This is the first kind of red flag, that this is the first underwriter that I really respected to say to me this was discreetly to say, actually, we're coming off. This is not going to happen anymore. What's fascinating me about the whole algorithmic, automatic, and obviously I'm sitting in London, I'm seeing this more firsthand, but of course this is going to globalize. And in fact, we're already seeing that a lot of large broker facilities are now globalizing. They're not just London facilities. They started as London only type things, but they're globalizing in the way that they should. What I thought was always fascinating about effectively giving you, Greg, this kind of dial and saying, if you're doing something algorithmic, and you could say, well, actually, where does the buck stop? It stops with Greg. He knows what he's doing, and he's got the board with him, and he's got all the non-execs on the board. And then you've got your hands on this dial, and you can move it up or down. So I thought, well, if you go to 0 to 1 billion algorithmically in a hard market, then presumably you should be able to go from billion back to 0 again, as long as you don't touch the dial. But then it will be your responsibility. Of course, you won't be able to blame the brokers or any rogue underwriters or anything, because ultimately, I suppose it has to be your responsibility at that point.
Yeah.
If you change the dial and say, hey, well, actually, I'll dial it down. I don't mind. I can dial it down a bit.
In the end, it's all about flow. How do you get business to flow to you as a carrier? Yes, historically, and still to this day, I strongly prefer to have it flow from a broker to an underwriter, that there's some reason the broker and the client value Vantage, and whether it's our speed, whether it's our expertise in the areas that we are focused on, the personal relationships of decades of trading together, and so forth. The reality is that sometimes across a large swath of the marketplace doesn't get it done. And then the first stabs at this were not great. The portfolio as a whole looked great. I am a firm believer and have used data over the years to show that it doesn't really matter who brokes the business generally, by and large. And most brokers will broke most risks, not ones that are a real problem, but they will broke most risks. And so it all becomes, well, if I believe that, then how do I get a flow of business from XYZ broker? You try to do it the transaction on transaction. The other way is to say, no, I'll just take a slug of that. And if the data is good enough, you can see how that portfolio is performing. Now comes the hard part, which you just outlined in the question is, all right, that's all great. We're up here, pricing levels, healthy margins. Lloyd's is printing 20% returns on capital. All right, now what happens when it goes to 15, or now what happens when it goes to 12 and a half or 10?
Yeah, because it's like sort of sitting in a warm bath and it's getting progressively colder. At some point, you have to jump out of the bath and go and get the towel on.
The wonderful thing about the data is you can try and fine tune it so that I glide
down.
Yeah. The hard part is, where does the glide stop? Now, shrinking to greatness is not a rational business model, but there is some way of, I can make that part of my portfolio much smaller than it was before, assuming it's something you do as part of an overall trading platform, which you see most of the underwriters. And again, I'm able to speak a little bit more freely because we're not in London yet, and so I don't have a stake in it. But the people you see on a lot of those facilities are part of a very, very large organization, part of an overall portfolio. And so if it goes up and down, it's not as painful as it is as if it's your whole business.
I'd like to pick your brains, actually, your underwriting brain, and obviously, your portfolio, that underwriting portfolio management brain that you've been exercising for so many years and with so much success. When you have to re-underwrite a portfolio, what percentage is it usually that's the bad part? I mean, it's sort of 80-20 most of the time, isn't it? If I could stop doing the 20 dumb ones that lost me loads of money, I'm probably be okay, because actually there's an 80% of them that are actually very nice risks, and they're not aggressive in the way that they renew. They're not asking for 20% off. They're actually pretty loyal customers. I'm very happy with them. Generally, they're performing fine. Of course, they have losses, but but they are performing better than that other 20. That is the one that I don't mind leaving. And I suppose the real art of underwriting is finding and engineering a situation where you can allow that 20% to evaporate, but without affecting the other 80. And so you still get shown the other 80, which is the hard part, of course.
Yeah, it is. And this has paid off for me over the decades in the analytics approach. And I would say this, generally, whenever you think about it, I think about it intuitively of what we've been doing. I've been doing for 40 years, almost nearly. Geez, Luis, that's a hard thing to say, but it's true in a couple more years, is that I'll use the analogy of the deciles, the multivariate pricing models, the AI, whatever we want to label we want to put on it. Generally will produce a distribution which chunks up your shares in the deciles. And the bigger the sample size, so the more, say, small commercial, tens of thousands, hundreds of thousands transactions, the more the deciles become very defining. And yes, it almost always is the bottom 10 to 30%. The bottom three deciles are the ones that drive the really poor outcomes. The market also, oddly, tends to way underprice those bottom three deciles and overpays the better performing top three deciles. And so would you be able to do what you just described? It would be nirvana. I'm not doing any more decile 1, 2, 3. Thank you very much. I'll just take all of these and off you go. Brokers don't need a machine to understand very quickly what's going on. And then your flow of the really good ones starts to slow down as well. And so you're in a constant battle of, how do I decide when do I help a broker or a client I might support across multiple lines that's in that bottom three deciles and contained with enough knowledge about it and lever that into the better outcomes on the better deciles. That's how I've always thought about it. Even if we don't have a model in play that's doing that for us mathematically, just in we call it tiering, right? Just divvy your book up into 5, 7, 10 tiers and try to make sure you understand when I do something in the tiers that are going to drive more losses, I'm doing it in a very thoughtful, controlled, I'm writing less limit, I'm trying to put some exclusions on it and lever that into the better pieces of the portfolio. If it were that easy, Mark, I'd have been retired 10 years ago.
I think this is a bit where everyone understands that underwriting is not just science, that there's art in there.
It's a fundamental principle of Vantage. Talent's our number one asset. What I said at the beginning and today, and what I'll say for as long as they let me keep doing this, talent's the number one asset. If that's one, 1B is the technology and the data and the setup to be able to provide better insights to the best people to make the best decisions. And that's all about what we've been trying to do here. There is nothing that we do currently where the machine can outthink the human. Again, if you're in personal auto, if you're in homeowners, absolutely, the data sets are vast. The algorithms are so strong. You still need a person to kind of move the dials, as you were saying earlier.
Yeah.
But by and large, the data is driving you to where you want to go. That's not the world we operate in at Vantage.
Yep. At that facilitisation and that smart follow strategies, if you've got all the tech and you've got the right people, is it something you'd be interested in doing, or are you already doing it?
As you noted earlier, a lot of this is happening in London. We don't have a London capability.
If someone got on a plane and said, hey, we're going to globalize this now, these days it's all electronic and who cares? It's all JSON files flying around the world and you could be fully plugged into our API if you want to. And we've got all the licensing sorted out and, the security is all sorted out. Client's very happy, want to have a Bermuda fragment of this or whatever it is. Would you study it? Would it be of interest?
100%. I mean, it fits in, again, I would not make it 50% of what we do, but it would fit in as another sleeve of a way to access risk that as long as we can understand it, we would be willing to consider it. Yeah, absolutely. Yep. Certainly for Vantage, the reinsurance book that we have is, we're underwriting the underwriters. It's very much, we're getting portfolios that have been constructed by others. And we think that's the right way to go after that set of risks that we've chosen to do that on.
What would have been the best use cases for the AI? Obviously, you've had this great situation coming in with no legacy 5 years ago, and you were able to build everything from scratch. And obviously with the benefit of all your previous experience of being able to build, the best of what's available today. How's the AI experimentation? How's it going? How much are you able to augment those underwriters? And obviously there's all the frictional stuff, the ingestion, the kind of boring stuff, and it's good at doing that. Or in terms of, just making people more productive, I suppose there's that difference. How much is it making people more productive and how much is it making people more skillful?
Yeah. So when we set this up 5 years ago, I thought we would be having kind of a 50-50, maybe even 75% more skillful, 25% operational, because we tend to be in that segment of the market where the premium per policy is large enough, the operational doesn't quite drive your outcome as much as it might in a flow business. It's ended up being the other way around. And there's a few reasons for that. One, look, it's just easier. People are happy to use AI to ingest a submission. One of our use cases is we used to have our cyber underwriters reading these 100-page applications from Marsh or Aon or whichever broker, hundreds of questions answered and so forth. Now we run them through a large language model, and over 85% of the time we get with 90+% accuracy, the 30 or so that we really care about, annotated as to where in the document the answer was found. And it's on the underwriters to make sure they check that that's there. And so we've cut their time from hours down to minutes. That's been the bigger part of what we've done. And in fact, there was an MIT study recently showing the same thing across a broader set of industries, which is it's much more about operational than it is about true risk insights. Now, we've done a few risk insights. They're just harder to do. They're harder to do in our space of that upper middle market, large corporate insurance, reinsurance world, because the data sets are smaller. It's a little more speculative industry. But I'd also say the one thing I've learned here the last 5 years, I knew it before, but able to really focus on it because In prior iterations, we were spending 12, 18 months on the data just to get it right, to then go do the work. Here, the data is right day one, so you can start doing the work, and so you're able to learn faster. Change management, just getting folks to change slightly the way they do things from how they've been doing them, even in a firm as young and vibrant as Vantage's, has been a challenge. And we've learned and we've gotten much better at it. But I would say certainly the first 2, 3 years, there was a lot of kind of stops and goes. And does this model really work? Is this the right answer? How do I think about this? Well, this isn't what the client or the broker wanted. So just moving through that change management process has been fascinating. I think we're much better at it now. And so you'll probably see from here more lift from the insights, but certainly day one has been operational. And we've still got a mile of opportunity on the operational side as well.
Yeah, so you're getting hopeful that you're going to start having real insights on, when you're letting something loose into your data lake or whatever, and seeing what kind of patterns and things they can find out. Let the sort of Loch Ness monster loose in the huge Vantage data lake and see what it comes up with.
So to be successful at it, it takes the coordination of somebody from underwriting, somebody from actuarial, because you still need the traditional, how do I bring this all back to the world of insurance pricing, somebody from data, and somebody from technology. And so those four things have got to come together. And at any one time, any one of those four could be leading the way in the project. I got a data person that sees something, to your point. I'm not sure that's a Loch Ness monster, but the Pac-Man gobbling up all the data and
yes,
generating insights. But quite often it's coming from the underwriter or the actuary. And it's a hypothesis of one of the ones we've had success with is something called our legal venue model. So it's a forward-looking index of all the different legal venues in the US of high, medium, low. And it helps particularly our healthcare underwriters, but also our excess casualty underwriters, when they have a risk that sits in one or two or four jurisdictions, how do they judge the riskiness of being in that jurisdiction were something to happen?
right.
And it's, yes, what did we do before? We kind of had gut intuition. We looked at the outcome of a year or 2-year-old study, and we took that and levered it into, well, what do you really do here? And then the data guys came along and said, okay, well, I can enhance that with this set of data. I give you something a little more prospective than retrospective.
Yeah.
So it's worked very well. But yes, the future is to have more of those faster and better.
It's interesting because sometimes it could be the data people saying, hey, to the underwriter, we found a correlation here. We think it is. But at other times, I presume it's the underwriter saying, I've got a bit of a hunch about something. I've noticed in the last 10 losses have all had something in common. Is that a pattern? And they can go back to the data people and say, right, can you go and prove that thesis?
Yeah, that's where we have a disproportionate number of curious people. They're still people. They still need change management. It is not a slam dunk every time, but those conversations happen here. And then we try and prove them out. And yet that idea generating moment is not always one that you get just in the regular course of duty. You've got to kind of spend the time outside your day-to-day to think about what can I do here with others to help make us better.
I suppose, yeah, you've got to build that into those underwriters' time, into their timesheet, haven't you, I suppose, Greg? And that's down to you as a manager to really say, actually, I want to give you an hour every now and again to go and actually think sort of outside your own portfolio.
In every underwriting business, you need one or two folks that are thinking about this more than just occasionally. Sometimes it's the underwriting leader, which is great, but sometimes it's a strong number 2 or number 3, and that's great as well. And sometimes it's somebody who's only been doing it 4 or 5 years and just realizes, hey, wait a minute, we were struggling once upon a time, not at Vantage, but at another location with non-US D&O. And it took somebody who was not the most senior person to all of a sudden say, hey, you know what, whenever we have a U.S. exposed risk, we're massively underpricing it relative to what the U.S. market would price it. And he found that just by sorting through the data and splitting the loss runs and everything by just that one simple idea. And it was, to me, a reminder that it can come from anywhere.
Absolutely. And I remember as an international casualty, when liability broker, there was always that nervous moment. If the turnover starts to get more than 10% US, you suddenly think, well, I'm going to lose this account because that 10% is worth more than the rest of the 90. And I don't know how to do that part. I don't really have the expertise.
Right.
It was interesting. We were talking before about flow and also about removing that friction. And we're chipping away and we're having success with that, with the digitization, with the smart market that we're creating. It's interesting, particularly mentioning flow, because if you look at other markets that are fully digitized, for example, stockbroking, there is no commission, for example, which is quite interesting. You've got Robinhood brokerage accounts that it doesn't cost you anything to trade stocks, which seems crazy because Robinhood's being paid for the deal flow that it's creating.
Right.
So you get paid commission one way or another. But what other things might change? You think, very long term, most progressive brokers might say, actually, yeah, I kind of agree that we may one day be paid for the deal flow that we're producing rather than the commission specifically contract by contract. For example, how do you think the nature of the market's going to change long term?
It's a great question. The brokers have a bit of a conundrum, I think, because they operate such high margin businesses that are highly sought after by the equity markets. It's one of those ones, well, gee, do I believe enough in the future that
you're going to be the first one to disrupt themselves because your stock price is not going to look good.
Exactly. So I would use the lens of the size of customer to kind of maybe think together here what you could see in the future. I have a home here in Connecticut, I have a condo in Florida. We have one car registered in Florida. My very fine carrier who shall remain nameless in Connecticut won't do that part of it. I went online and bought a policy from one of the big direct auto players. It was no friction, easy, right off the internet, and fully finished there, right? No need to go talk to a person up the old days. So you're seeing that kind of direct flow in those easier lines of business. I think small commercial would be one where you could envision whole blocks of business and how much you monetize those differently. I think if I go back to the beginning of our conversation and reflect on, if we believe the hypothesis the world's going to be a riskier place, and that certainly large middle market, large corporate customers need some kind of bespoke solution and need it in sizes that exceed what one or two or three carriers can do. I don't see it getting all the way up there and redoing that side of the market. That there's still going to be this something. Now, can we do it more efficiently and effectively digitized? Yes, 100%. But for the moment, we don't see anything that really takes on that whole big equation of, let me just go do this and really fundamentally turn the whole thing upside down. Now, never say never, but what I described to you at the upper end of the market, is it really that dissimilar from what Lloyd's was doing 300 or 400 years ago, just instead of with quill, pen, and paper, it's now all digitized. It's kind of the thesis of why we believe strongly in talent here.
Obviously, we're at this stage of the cycle. We've already seen a sort of starting pistol fired on strategic M&A with balance sheet businesses, different corporate actions happening. What's your view? I'm remind you, I was listening back to what we spoke of this time last year. You said London might well be the last piece of the puzzle. It might likely be something with London. But then you said that's not a 2024 thing. That might not even be a 25 thing. Might it be a 26 thing?
It might.
Well, it all depends, doesn't it? These things, they're not that predictable.
No. I very blessed to have more than enough economic capital here, strong from both Best and S&P, strong capital surpluses there, well beyond what they require us to have. So we feel good about that. It's not always fungible between legal entities. They've got a regulator in Bermuda, they've got a regulator in Delaware. If you added London, you'd have a regulator there as well. So it's been more about how do we navigate that. I still think it's on the horizon. It isn't going to be a 25 event for sure, but I wouldn't rule out 26 or 27. It really is the last piece of the equation for what we want to build here in terms of being able to access a broader part of the world without going out and planting flags everywhere. So we'll see.
It does seem that London's done a reasonably good job of making itself more attractive and making it a little bit more simple, with things like London Bridge and the Lloyds, making it slightly easier for capital to come in and out of the market.
We've admired from afar what the prior leadership at Lloyd's and now the current leadership at Lloyd's is doing, how they're running it, how they're simplifying the bureaucracy there and making it more fact-based around what the risks are and what things need to be really looked at hard by Lloyd's. So personally, I'm a big fan of what's changed there. It isn't about worried about the expense side of it. It really is, when do I have enough fungible capital to do something that's not just a trade, that it's actually a real business, whether that's acquiring something or whether that's building something organically. We'll have to see as we go here which way we go. But I'm a huge believer that Lloyd's done a great job of ignoring the technology piece of it, of modernizing their guidelines, their regulations, their rules, the way they go about managing the agencies.
Supposed to be to have a shout out to the FCA, particularly, and the PRA, having to be more mindful to the competitive position of the UK and having that sort of institutionalized. It's certainly made a difference, because I've been talking to the people who have to deal with them every day, and they're much happier in their dealings than they ever have been.
I'm a little out of that. I'm 6 years now out of date. So
you'll be getting yourself up to date, one might expect. But otherwise, is there anything that I haven't asked you yet that I should have asked you, Greg?
You didn't ask me, well, Greg, how are you going to recognize value for all this great work that
Well, yes, I mentioned corporate actions. Yes, we've seen they're not just M&A. Obviously, we've seen lots of IPOs, for example. Might that be on the horizon as well?
Yeah. So for us, we've been blessed. Hellman and Friedman, the two core investors, Hellman, Friedman, and Carlyle. Hellman and Friedman invested in a little old company called Mid-Ocean, which I went to back in 1995. My first job in Bermuda, they were invested in Dinos' startup at Arch. Some of the people at Carlyle that were originally involved were at Warburg, and they invested in Arch as well. I'm known with folks at Carlyle for a bit as well. So it's a really good group. And when we set out on this journey, we said it's a 5 to 8 year window of when you might think about monetizing or recognizing the value that's been created by everybody here. So we're just entering that window. We've spent 25 doing a lot of work around 10-day close, Sarbanes-Oxley, financial controls. So to be able to say that we would be ready to go and do an IPO if that came to pass. Nothing imminent, but that is certainly a path over the next few years as you might think about IPOing. You also might think about something strategic as well. And so those things, you can't plan for them. We're very picky about who we might or might not talk to. The general theme would be Vantage being something that lifts this potential new source of capital as a geography, as a line of business, or as somebody that really wants to own a balance sheet platform. And so we have these conversations. My team and the folks here are very familiar with how fond I am of saying these things have, when you start out on them, they have about a 1% chance of happening. Therefore, the things between the two things I just described, maybe an IPO, maybe a strategic. And by the way, just keep building the best Vantage you can. And that usually takes care of itself. So a lot of different branches of that tree. We keep the tree fertilized, well-fed, and gain that optionality. So
as long as it's a really nice, attractive tree, then
I think so. I think it's a nice looking tree. And then as you started the conversation with, it's fall here as well. And there's nothing better than a bright orange or deep red tree getting ready to transition from summertime into wintertime.
Well, we'll be watching this space. I'm sure we'll be talking this time next year, and things may or may not have happened in the way that they are. You never know. If we talk about it too much, you'll end up jinxing it. Certainly, a friend of mine works in film, and I always ask him, "Oh, what are you up to?" And he says, "I can't talk about it because if I tell you, then it won't happen." It's a bit like that.
I think that's a great way to leave it, and would love to come back in a year and do it all again. And
yeah, let's do it face to face. We've got to catch up face to face. So yeah, we'll do something. That'll be really good fun. But Greg, in the meantime, good luck with everything. Keep growing, keep a smile on your face, which is firmly there right now. And then book in a time to speak at some point in the future.
Mark, thanks for having me. Really appreciate it.
Thank you. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Vantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.